If the loan is less than $10,000, then no tax update. Capital gains only come into play if it is a capital asset. One Bitcoin is worth $39,984.70 in US dollars. Ask Roger. Hey guys, I'm Roger Herring. I'm the Investor's Accountant, and thank you for coming by our YouTube channel. Before you leave today, be sure you hit subscribe and click the bell. That way you won't miss any of our free educational videos. So right now, click subscribe, hit the bell, and a great video is coming your way. Hey guys, I'm Roger Herring. I am the Investor's Accountant, and thanks so much for coming by today. You know, about a week ago, I put a post up on Facebook, and it basically said, please, please, please don't let your parents or older relatives do their own estate tax planning and gift planning. Yeah, the problem is they learned everything they know from great-granduncle Bob, and he died 40 years ago. And they think they're doing good things, but they actually, in some circumstances, wind up costing themselves or their children more money that in taxes now than they would if they had just let the kids inherit. So I thought we'd talk a little bit about it today. Here's how it came about. I got a call from a gentleman's financial advisor, and she said that she needed some help, that she doesn't work in real estate and doesn't really understand it. But she had a client, an older gentleman, that had just sold a piece of property and then gifted the proceeds, and she didn't know what the tax treatment of this was going to be. And I said, okay. So without really going into detail or revealing any confidential information, why don't you give me the general background of what happened? She said, okay, he had a piece of property. He wanted to give money to his son. First alarm bell went up. The gift was not to a 501c3, so the gift is not deductible. The gift was to a child. Now, there are a lot of reasons to do it, and I'm sure he had a good reason for it. So I said, please continue. She said, okay. So the son got most of the proceeds that came off of the property. The property sold for 7 figures. And he's getting an appraisal done on the property. I said, wait a minute. Why is he getting an appraisal done on the property? Well, he said he needed to know the fair market value. I said, okay. He would only need the fair market value today before he sold the property. What matters is not what the fair market value of the property is today. What matters is his basis. Well, basis? What's that? Yeah, what's that? We got problems. So, when I put up that I was going to do this post on Facebook, and I did that yesterday, I got a lot of folks that responded to it and said, hey, I want to know about this, I want to know about that. So, based off that original story, I thought we would talk about some of the basics of estate planning, estate tax, and gifting, and then we'll come back to the story that we started with, okay? So, estate tax. It's nasty. It's worse than the income tax. It's anywhere from 18 to 40% of the value of the estate. And the value of the estate is the fair market value date of death. So if there's hard assets like real estate or there's stocks and bonds, not what you paid for it, it's whatever the fair market value is that's going to be taxed. Now, the good news is you do get an exemption. And each year that exemption is indexed for inflation. So the current estate tax exemption is $12.06 million. So here's your example. If your estate is valued at $14 million and you've got the exemption of 12.06, that means that only 1.94 million of the 14 is taxable. Now, just like the income tax is progressive, so is the estate tax. So the first $10,000 you're going to pay 18%. The next X amount you pay 20%, and it keeps going up from there to anything $1 million and over. You pay 40% of that back to Uncle Sam. Ouch. 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 So you're saying, well, Raj, my estate's less than $12 million. I don't have to worry about anything, right? Wrong. There's still things you need to know, because there's things, if you don't do, it'll hurt your family in the long run. So, first thing to realize is that if you pass away and you're married, your spouse inherits totally tax-free. If I pass away, my wife gets all of my assets, and I don't need my exemption. Well, Roger, you just said it. You don't need it. But there's something called portability. Well, what's that? That means my wife, Shelley, can file an estate tax return and transfer my $12 million exemption to her. Now her estate tax exemption is $24 million. Now, why is that important? Because in 2026, the estate tax exemption is scheduled to drop to $6.2 million. Well, Roger, won't yours drop too? No, I'm history. I'm out of the picture. My $12 million, there's a principle called no clawback. That was the exemption the day I died. It stays. So if her exemption by law drops to $6 million, she's still got my $12 million for a total of $18 million exempt. So when she passes away and our children inherit, they would only have to pay taxes on anything above that $24 million or $18 million or whatever. And it becomes really important, portability, because a certain gentleman named Bernie Sanders drafted a bill that was trying to drop the estate tax exemption down to $1 million. That was all part of the big Build Back Better hoo-ha that went on last year. Thank goodness that's totally off the table. It went nowhere. Now, there's something else that everyone needs to know, and it pertains to real estate, whether it's rental real estate or a primary residence, a second home, raw land, whatever. Okay, so the third thing that you need to know is about a thing called the stepped up basis. Now, first off, what the heck is basis? Well, I talk about it with S-Corps and partnerships. I call it skin in the game. Basis is basically how much money do you have in a piece of property or a stock or something like that. And basis can be determined three ways. Okay? First off, what did you pay for it and what was the cost to improve it? That's one way of establishing basis. Another way of establishing basis, if the property was given to you, your basis is whatever the donor's basis was. So, if my mother had given me her home during her lifetime, okay, then her basis, her original basis, which was $53,500, that would be what my basis becomes. Okay, so I'd have a heck of a capital gain. The third way is the stepped up basis. That's when you inherit property. When I inherit that house from my mother, I will get a stepped up basis from her $53,500 from where she bought it in 1979 to the current fair market value of $580,000. And the benefit here, I can sell that property and there's no capital gains or very little capital gains. Or let's say that my mother had turned that into a rental property. She's got all this depreciation that she's going to have recaptured, right? Wrong. Because the stepped up basis eliminates depreciation recapture. It goes away. I have the option of selling the property, or if I put it back in rental service, I could start depreciating it again, but instead of a basis of $53,500, I would use $580,000. Isn't that nice? Yes, it is. That's stepped up basis. Now, let's talk about gifting. Every year, you have an annual gift limit. For 2022, it's $16,000. So, let's say I wanted to give my son Ryan $16,000. I could do that, no questions asked. Hey, I'm married. What if my wife Shelley also wanted to give Ryan $16,000? She can. So Ryan gets $32,000 and we don't have to do anything. It's just done. You know what? I could do the same thing. I could give the money to my son Steven. And Shelley could give the money to Stephen. We could give it to our daughter-in-law, Destiny. We could do it to anyone as many times as we want, as long as it's $16,000 or less. No questions asked. Now, Raj, what if I wanted to give my son $1 million? That's not a problem. Because what you're going to do is you're going to file a gift tax return. And you're going to do something called use your life exemption. How much is your life exemption? The same as the estate tax exemption. Right now, the $12 million. So I want to give Ryan $1 million. What do? I file the gift tax return. I use my life exemption. And now I have reduced my life exemption from $12 million to $11 million. I pass away. All the assets go to Shelly. She does portability. Now she ports $11 million instead of the 12. Not a problem. Now, I do have the option of going ahead and paying the gift tax if I wanted to on that. Now, that would be 40%, and that's not pretty. Okay? So, use the life exemption. Now, who files the gift tax return? The donor files the gift tax return. Whoever makes the gift is responsible for filing the return and paying any taxes that are due. You got to do it. Now, let's say that I want to avoid probate and I decide that I'm going to put Ryan on the deed to my house. Would that be cool? Probably not. Why? Because that constitutes a gift. I put Ryan on the deed. Let's say I'm on the deed, Ryan's on the deed. Essentially, I've given half of my house to Ryan. So my basis in the house is what I paid for it, and let's just say that it was $500,000. Okay? Now my basis drops to $250,000, and Ryan has a basis of $250,000. 10 years from now, Ryan inherits the house. The house is now worth $800,000. Okay? Ryan gets a stepped up basis to $800,000. Right? Wrong. You see, I'm the one that died. Only my assets get the stepped up basis. So Ryan's basis stays what? $250,000. He gets a step up in my basis to 800 divided by 2 is 400. So his basis is 650,000. If he sells the house for 800,000, he's got a capital gain. Maybe not the best idea in the world to add your kids onto the property. Now, let's go back to the original story. The gentleman wanted to give his son 6 figures worth of money. Now, there can be a lot of reasons, and a gift during your lifetime, it can have a lot of impact. It can be emotional. It could fulfill a need. It could solve a problem. There's any number of reasons to do this. I'm just saying that there may have been a better way to structure this, and it would have been better to sit down with a pro that knows what they're doing before you did the transaction. But here's the bottom line of what happens in this circumstance. He sold the property. He gifted the money to his son. He's going to have to file a gift tax return, and he's going to have to use his lifetime exemption so he doesn't pay taxes on the value of the gift. He's going to have to figure out what his cost basis is in that property, whether he bought it, inherited it, or whether it was given to him. And he's going to have to figure out the capital gain on his taxes, and he's going to have to pay a capital gain in the 6-figure range. Ouch. Alternatively, if he'd have let his son inherit, the son could have had a stepped up basis. That's it for today, guys. I hope you enjoyed this segment and have learned a little bit. You know, give me some comments down below or message me over on Facebook. Tell me more of what you would like to hear, and we'll do our best to get it on the air. Till the next time, Roger out.